Hi, my name is John Dowdy, and I'd like to give you a quick review of the stock market for the weekend in June 28th, 2013. This is also the end of the first half of 2013. What we'll look at is if the action last week was it a throwback or was it the beginning of a recovery? If you'd like more data after viewing this video, please come to my website, www.superchargedretirementincome.com. To obtain a full picture of the stock market action, it's important that we look at multiple time frames. We'll look first at the short to intermediate time frame using daily charts. Then we'll look at the long-term view using weekly charts. Okay, this is the short to intermediate time frame. And as you can see, this is the action last week. On last Monday, we broke lower, went all the way down to 155.73. Made a new low for the intermediate term. It looked like we were breaking down, but then we had a terrific Tuesday where we zipped back up to 160. Then Wednesday was also some good action, and on Thursday we moved up to the 50-day moving average line at about 162. Now, I also have put here the 20-day moving average line, and it just so happens that that was also at 162 also. So 162 has become very strong resistance. And in fact, we did bounce off the 162 on Friday and move down to 160 before recovering a little bit at the end of the day. The question is this a throwback or is it really the beginning of a recovery? And we will not know until we either take out this 162 or fall back below the previous low. So that's what we'll be watching for in the next days and weeks ahead. To give you another perspective of the market, I thought it would be interesting to look at what's called Fibonacci retracements. Fibonacci was a mathematician in the Middle Ages, and he discovered that a lot of numbers in nature followed a particular sequence, and that sequence is now called the Fibonacci sequence. And some people have applied this to the stock market, and it seems to have an uncanny capability of marking resistance and support. Why would this work? Well, it's not clear, but I think it's because there are a number of algorithms used by program traders that rely on Fibonacci retracements. So if we near support, these algorithms kick in and buy. If you're near resistance, these algorithms begin to sell. So what happens is that the Fibonacci retracement numbers, because they're used by the programs, become a self-fulfilling philosophy. But for whatever reason, they do seem to actually work in many cases. Now here I've drawn the Fibonacci retracements from the May high down to the November of 2012 low. So this whole sequence of data, we've marked the Fibonacci levels, and this shows how much we have fallen back below. Right now we've fallen from the top. At the May high, we've fallen 38.2%, and as you can see, it bounced right off that 38.2 line, and we had a recovery. If it breaks down below the line, the next line is the 50% retracement, which just so happens to be right at the 200-day moving average. So this will be another very strong support level. If we break below that, then we come to the February low, which is another important support. That happens to be the 61.8% Fibonacci retracement level. We break below that, then the Fibonacci says we'll probably go ahead and make a new all-time low, probably enter a bear market. So that's going to be important that these support levels hold. Now, to give you a more short-term view, I also put Fibonacci retracements from the May high to the June low. So going from high to low, how much have we retraced of that fall over the last week? Well, actually, we retraced about 50%. It's a little hard to see, but the 50% retracement level is right at the 50-day moving average. Again, very strong resistance now. We have the 50% Fibonacci retracement, the 200-day moving average, and the 20-day moving average, all converging at 162. So 162 will be key. So in summary, over the short term, yeah, the market did bounce last week, but it's not clear if this is the beginning of a recovery or just a throwback to the 50-day moving average at 162. 162 is key. It's the 20-day, the Fibonacci 50% retracement. So we're going to have to take out 162 in a convincing manner for the bull to recover. Now, although we've had a correction, we still have a very good year this year, around 13% from the beginning of the year. But the big question is, where do we go from here? So there's two things to look at: the 162 resistance, and otherwise the support levels are 155.73. That's the June low. If we miss that, the next support is 153.55. Then we go all the way down to the 200-day moving average at 150.68, and then the final 61.8% Fibonacci retracement level is right around 148 to 149. If you're a trader and want to use stops, then these could be your stops, either very near-term stops, or you can give yourself the market more leeway to move. If this final support is broken at 148, then we could be in trouble. Now, we could go all the way down to 135 to 140, which would be around the 17% retracement and very near 20% bear market territory. Let's look again at the long-term view. This shows the 2007 high at 157, a little over 157, and that we broke out from that high. This is what we talked about this last week. And we broke out convincingly, went all the way up to 170, but now it looks like we're having a throwback. So the long-term view does not look near as bleak as the short-term view does. It looks like this is just a run-of-the-mill throwback to the breakout point. The key is that this has to hold. Last week we went below it by a little bit, but it did not hold, and we closed above it, which is key. So in order for this to be broken, we have to close the week below this support level. If that happens, then we're probably going to go down to hit some of the lower levels. It could go all the way down to the 135 level before we get really major support. However, if 157 holds, then we should bounce off of that and move strongly higher, and the bull market is still intact. So from a long-term view, the bull market is still in force. We haven't violated any major tenets of the bull market. It looks like the last couple of weeks were a simple pullback in this long-term view, which is not unusual at all. In fact, that's positive for the market to have a pullback and then bounce off the support line. The key now is 157.47 for the long term. This is the same level that we talked about last week. If that's broken, then we can move all the way down to 135 to 140 level and have a very major correction. But if we hold the 157.47 level and bounce off, then the bull market is still intact, and we could have significantly higher prices ahead. So, a quick legal disclaimer. The contents of this video is for informational purposes only and should not be construed as being investment advice or any offer to sell securities. This is my view only, and you and only you are responsible for your investment decisions. And of course, anytime you invest, there's a risk of loss, and past performance does not indicate future profits. So be very careful. Over the next week, please watch the market carefully. Let the market be your guide, and good luck. Thanks for viewing. And as I said, if you'd like more data, please come to my website, www.superchargedretirementincome.com. Thanks.